Hello guys, in the following minutes I will show you a simple but powerful trading strategy that will help you to take advantage of failed breakouts. As you probably know, one of the classic rules of support and resistance is that support, once violated, becomes resistance, and conversely, the resistance, once violated, becomes support. We can find many examples of this principle in real market action. This chart shows a classic example where a resistance level held at point A was broken at point B and then held cleanly as support on a retest at point C. This chart shows another example where previous support was broken but then held as resistance on the next retest. These are textbook examples of price action around support and resistance levels, but there is one small problem. Only 15 or 20% of these price moves are valid, and the rest are simply failed or fake breakouts. A false breakout is when the price moves beyond the previously established price range, but then retreats back to within the range. Since a range is basically a battle between the buyers and the sellers, pushing in opposite directions, these false breakouts often occur because support and resistance are not 100% accurate. Here's a harsh truth. For most novice traders, trading breakouts will be a losing strategy. The trading reality is that explosive gains are quite rare, considering the many potential ranges available to trade. And even if you anticipate the breakout correctly, you will still face problems with maintaining the position. But while a range breakout may be difficult to trade profitably for many traders, there are alternatives using the same chart pattern that will give the trader a better chance at success. This is the pattern that we will try to spot on our charts. And here's the logic supporting this strategy. Markets hunt for stop orders and activity beyond significant price levels. Many times there is no real conviction behind these moves, and the price moves fail and reverse quickly once the stop orders are triggered. If this breakout occurs and fails, there will be many trapped traders, which can add momentum to the opposite direction from that level. Entering after such a move allows for excellent risk-reward potential with a clearly defined risk point. The best examples of this trade occur in extended ranges and will usually be followed by a momentum divergence on the trading time frame. In this example, for a short entry, the market trades above a clearly defined resistance area, but immediately reverses on the following bars and closes back under the resistance. There can be significant volatility, volume, and activity on the breakout, but there should not be a continuation beyond the level. The final confirmation of the fake breakout is the momentum divergence. Here's another example. Here we have a clear support, the price being unable to continue lower. Point A marks a brief breach below the support, but immediately closes back above the support level. Once the movement was confirmed by the divergence, the wiser trade would be a long position instead of chasing the failed breakout. On the next chart, we found this pattern once again. The price attempted to break to new highs, but there was not enough buying pressure to hold it above the resistance level, and it failed on the same day. The divergence was there, so the higher probability trade would be on the short side. This chart shows another classic example of a fake breakout. After the resistance was broken to the upside, the first instinct is to go long for a continued trend above the previous highs, but the market actually closed below the resistance level and reversed. When we trade this setup, The stop is clearly defined, just beyond the extreme of the fake breakout. Because this is an aggressive counter-trend trade, it's important not to add to losing trades or widen our stops. In what concerns the profit taking, allow yourself to take partial profits as the market makes them available to you. For instance, one plan would be to take profit on the first part when the profit equals to the initial risk of the trade, meaning a 1-to-1 ratio. I prefer to swing trade with this setup, but this pattern also suits scalping. You will find many false breakouts on the 1-minute chart. You just have to manage your trades accordingly. The beauty of this failed breakout technique is the fact that there is no subjectivity in stop location and little subjectivity in managing losing trades. If the market makes a new extreme, then you are wrong and you must exit the trade. Here's another important observation. Ideally, the market should not be able to consolidate near the level. Consolidation near the level is more consistent with a continuation of an existing trend. If the failed breakout is successful, the price should move sharply away from that level. Once you find yourself in a trade where the price doesn't move or stagnates too long around the entry point, cut your losses, exit the trade, and search for better trades with hopefully more momentum behind them. If you got any value from this, please consider subscribing to our channel, share and like this video as it will help us a lot in the future. Until next time.